Owning a share of stock means you're a legal part owner of a company, and as a part owner, you receive a portion of its profits. This concept is captured by a key financial metric known as earnings per share, or EPS. In today's video, we're going to break down the EPS formula, show you how to easily find this number in company reports, illustrate simple examples to get a clear understanding, explore what causes EPS to fluctuate over time, and share some useful tips to keep in mind when using this metric to evaluate stocks. Hey there, this is Mavic Finance, where investing concepts are explained in a simple way. But first, a quick disclaimer. Let's start with the formula at the top: net income, which is the total profit the company earns after all expenses and taxes, minus the preferred dividends. And you may be wondering what the preferred dividends are. A preferred stock is a type of company ownership that gives you priority over common stockholders when it comes to receiving dividends. Preferred stockholders usually get a fixed dividend rate, meaning they know how much they'll earn. However, they don't have voting rights in the company, unlike common stockholders. So, if the company has preferred stock, these are the dividends paid to preferred shareholders. Since they get paid first, we subtract them from the net income because they're not available to common shareholders. All this stuff divided into the shares outstanding, which is the total number of common shares available in the market for that specific stock. Now that we know the formula, let's quickly show you how to find EPS on Yahoo Finance. You will type on the internet the name of the stock and Yahoo Finance. Then, over here, you will see the EPS. Keep in mind that this number may not always be up to date, especially when looking at smaller companies. Therefore, it's important to verify this data with other sources to ensure it's correct. Said that, let's say we have two companies in the tech sector, Company A and Company B, and we want to calculate and compare their EPS to evaluate which one is more profitable for shareholders. Company A. Its net income is $5 million. Preferred dividends are $200,000. It has 1 million shares outstanding. Company B. Its net income is $8 million. Preferred dividends are $300,000. 2 million shares outstanding. The formula for EPS for Company A is the net income minus the preferred dividends divided into the shares outstanding. So Company A has an EPS of $4.80. Now let's calculate the EPS for Company B using the same formula. And Company B has an EPS of $3.85. Company A has earned $4.80 for each of its 1 million shares after paying preferred dividends. Company B has earned $3.85 for each of its 2 million shares after paying preferred dividends. Even though Company B has a higher net income and more shares outstanding, Company A ends up with a higher EPS. This suggests that Company A is more efficient at generating profit per share of stock, which could make it more appealing to investors looking for value in terms of profitability. However, it's important to note that EPS alone is not enough to determine which company is truly more profitable or a better investment in the long term. To make a more informed decision, investors should also consider other metrics like revenue growth, debt levels, cash flow, the stability of the company's profits over time, and so on. While Company A may have a higher EPS, Company B has a larger overall profit, which could indicate stronger business performance in absolute terms. EPS can also be negative when a company reports a net loss, meaning its expenses exceed its revenue. Startups and growing companies may have negative EPS as they invest heavily before becoming profitable. A negative EPS shows financial struggles, but it doesn't always mean a company is a bad investment. Investors should analyze why it's negative and look at other factors like revenue growth, cash flow, and debt levels to get a clearer picture of the company's overall health. So what makes EPS go up or down all over the time? There are two main factors to consider: the profit and the number of shares outstanding. If a company increases its net income, its EPS will rise. This could happen if sales go up, costs go down, or the company becomes more efficient. If the company decreases its net income, That would be bad news for investors because the EPS would also decrease. On the other hand, if a company issues more shares, the EPS could decrease because the same amount of earnings is now divided among a larger number of shares. Think of it like this. Imagine you're celebrating your birthday and more people are showing up throughout the evening. When it's time to serve the cake, you'll need to cut it into more pieces so that everyone can have a slice. But with more pieces, each slice becomes smaller. Similarly, when a company increases its shares, the earnings, which would be the cake, are divided into smaller portions, which means each share gets a smaller slice of the profit. This is also called share dilution, and companies may choose to do this if they need quick access to capital. By issuing more shares, they can raise money quickly for various reasons, such as paying off debt or financing acquisitions. However, companies can also buy back their own shares, which reduces the number of shares outstanding and, consequently, increases earnings per share. It's like when almost no one at your birthday party wants a slice of cake, so the few who do get a bigger slice. Similarly, when a company buys back its shares, the remaining shares are entitled to a larger portion of the company's profits, which boosts the EPS. Some companies buy back shares to increase EPS and keep investors happy, as a higher EPS often makes the stock more attractive. EPS is also a key part of the price-to-earnings ratio, a popular valuation metric. If you still don't know what price-to-earnings means, you'd better learn about it. So I will leave the video over here. Just make sure to watch it after this video. You won't regret it. The P/E ratio compares a company's stock price to its EPS by dividing the price of the stock by the EPS. One of the most popular valuation metrics, I would say. So the higher the price of the stock is compared to its earnings, the more possibilities are that it could be overvalued. I think EPS explanation was clear, but finally, let's talk about the pros and cons of using this metric. Starting with the pros. EPS is simple to calculate and understand, provides a clear picture of a company's profitability per share, and can be used to compare companies in the same industry. Cons. It doesn't take into account company debt or future growth potential. Companies with fewer shares outstanding may appear more profitable, even if their actual performance isn't as strong. EPS can be manipulated through accounting practices, so it's important to look at the rest of metrics. That's all for today. I hope this explanation was useful for you. If you have any questions, let me know in the comments below. I'll be answering them as soon as possible. Like and subscribe for more value investing series, and I will see you in the next video. Bye.